Hello and welcome to the webcast entitled Basic Yet Powerful Chart Patterns with Jim Wyckoff. We have just a few announcements before we begin. The slides will advance automatically throughout the presentation. Should you need technical assistance, click on the help link. If your screen freezes or the slides do not appear to be advancing as they should, please try exiting and restarting the session, as it may be an issue with your connectivity. At any time, you can submit a question using the Ask a Question box that's located in the bottom left-hand corner of your screen. I will now turn the call over to Sonia DeRay from Kitco. Please go ahead, Sonia.
Hello and welcome. I'm Sonia from Kitco. Thank you all for joining us today at Kitco's Coffee Break webinar with Jim Wyckoff, Basic Yet Powerful Chart Patterns. Kitco's Coffee Break webinars cover a variety of topics: insights on the market, details on various products, and any information pertaining to the precious metals industry. Today's Coffee Break presenter is Jim Wyckoff. Jim has been involved with stock, financial, and commodity markets for over 25 years. His experience and specialized training in journalism and economics enrich his popular daily AM and PM roundups and his Technically Speaking column on Kitco.com. As a financial journalist for the FWN Newswire service, he covered every futures market traded in the U.S. Jim has also served as a technical analyst for Dow Jones Newswires, as senior market analyst with TraderPlanet.com, and as a consultant for the ProFarmer Agricultural Advisory Service. So have a coffee, grab a sandwich, and enjoy the presentation. Over to you, Jim.
Thank you, Sonia, and I'd like to welcome all the Kitco readers to my Coffee Break webinar. It's my mission in these webinars that to have you take away at least one valuable trading or analytical nugget that you can provide to your own analysis or trading methodology. Today, we are going to talk about basic yet powerful chart patterns. When I got into this business nearly 30 years ago, computer software, trading programs, and studies were in their infancy, and I had to plot all my charts by hand on graph paper. And I think that really gave me an advantage because I was able to look at those charts on a daily basis, draw those daily graph lines, and it gave me a keen understanding of price trend. And the traders and analysts that I've followed for the past 30 years, many of them base their trading analogies on trend, price trend. So we're going to do a little bit of review right here on the last webinar that I did when I discussed trend lines. Of all the seminars and books that I've read and veteran traders, successful traders that I've talked with, virtually all of them employ some kind of trend determining analysis in their trading methodologies, their analytical methodologies. There's an old saying that says the trend is your friend when you're trading markets, and that is very true. Most traders want to trade with the trend, and trend can be determined on various time frames, depending on your particular trading time frame. Price trend can be determined on a minute-by-minute chart. It can be determined on an hourly chart, a daily, a weekly, or a monthly chart. We're going to just do just a short review. A price uptrend is determined by a series of higher highs and higher lows, as we see here on this chart. A price downtrend is determined by a series of lower highs and lower lows, as we see here on this chart. And I will point out at this time, when you're looking at this chart, you'll see that prices don't go straight down. When you see a market in a price downtrend, you'll notice that there are a series of, the market will trend down for a while, and then we'll see an upside hiccup, or that's called reaction high in a downtrend. And then when a market is in an uptrend and the market backs off on some profit taking or whatever and trades down a little bit only to trend back higher, it's called a reaction low. So the series of reaction highs you can draw trend lines from, and reaction lows you can draw trend lines from. Now, a market, this is very important. Most people think a market can only trade up or trade down on the charts. In actuality, a market can trade sideways in a choppy fashion, as we see here. In fact, most of the time, most markets can be considered in a sideways and choppy trading range. So that's why it's extra important for a trader to identify a trending price move in a market, especially an early trending price move on a breakout from a congestion area or whatever, because those early trending price moves, a trader can jump on board and ride that price trend and score some good profits. Okay, we're going to start right out with some key chart patterns that what I call classical chart patterns that you can learn from reading classic books that have been written, 100 years ago by the likes of W.D. Gann or Charles Dow or Richard Wyckoff or Jesse Livermore, some of the famous traders of the early to mid 1900s. Here we have on the chart a double bottom reversal pattern. And I want to point out before I explain the double bottom reversal characteristics that these patterns that I'm pointing out to you can be applied to any chart, whether it's a minute by minute, daily, weekly, monthly. So the time frame by which you are using, you can apply these pattern recognition tools to your particular time frame, no matter what time frame that is. So here we have a double bottom reversal where you see a market has been trending lower and it scores the initial low. And then it'll correct back up a little bit in a sideways pattern, trade kind of choppy, and then drop back down. And then if it starts to trend higher again, that's when you can determine that a potential double bottom reversal pattern has occurred and that prices are likely to trend higher. Here's another double bottom reversal pattern. Once again, prices trend lower, see kind of a reaction bounce, maybe sell back off again, come right down to that support level at that initial low, and then bounce back up again. And it's at that point you can determine that that could be a bullish double bottom reversal pattern. Here's a double top reversal pattern. Same situation, just reversed. Prices have been trending higher, score the initial high on that first top of the double top. Then you see some profit-taking pressure, prices back off. Then you see a strong rally again and come up to challenge resistance at that first high, but then the market backs off again. And once again, it's at that point you can say, well, this is probably a bearish double top reversal pattern and prices are going to trend lower. An island bottom reversal pattern is a rarer occurrence. That is when a market gaps lower, and by gapping I mean when you're looking at the chart, you can see gaps between the previous bar and the present bar and the next successive bar. So if you see a market that gaps lower, a bar chart that you see a gap lower and score a new for the move low, and then maybe trade sideways for a few bars and then gaps back higher, that's a bullish island bottom reversal pattern that I have highlighted there. Again, these patterns are rare, and they're even rarer nowadays that you have electronic trading. Back in the days of open outcry trading, before the electronic overnight trading, the gaps were more prevalent on bar charts, but the nearly 24-hour trading that occurs in most of the markets now, it's harder and harder to see a price gap occur. But they do occur, and the rarer the price gap occurrence, that means even more powerful the signal when that gap does occur. Here's an island top reversal that's highlighted in green. You see a price uptrend, accelerating uptrend. The bulls are getting all excited, and then you see just a big surge of bullish enthusiasm, and the market gaps higher above the previous day's price bar. Then all of a sudden, bulls become exhausted, and prices gap back lower to form a bearish island top reversal pattern. Now, these chart patterns that I'm pointing out to you are what I call basic analytical tools, but I consider them to be the most powerful. You can, what I call my secondary trading tools are the computer-generated studies like relative strength index, moving averages. Those are important, but from my point of view and my experience of nearly 30 years, it's these patterns that you can look at on a chart without the aid of a computer and determine these price patterns, and those are the most powerful trading tools a trader can possess. Here we have a rare diamond pattern that forms. When a market has been trending higher and scores a new high for that particular move, and then trading becomes choppy, just choppy and sideways, sometimes a diamond pattern will form, and that is a bearish indicator that the market has probably put in a top and will start to trend lower. And here's a classic example of that. Once again, these diamond patterns at market tops don't occur very often, and when they do occur, it's a solid clue that the market has put in a top. And I want to point out also, especially to the newer viewers and the people that are new to technical analysis, technical analysis is more of an art than a science, so there can be differing views on, somebody might look at a chart pattern and say, well, that looks like a diamond pattern, and another chart watcher might say, well, I really don't see that. It's more art. There is no definitive definition by looking at a chart of a particular pattern. It's just what the viewer sees in his own mind based on his experience. Another thing, technical analysis is a powerful tool, but it's not 100% correct all the time. And if technical analysis or fundamental analysis were 100% correct all the time, wouldn't trading be easy? But that's certainly not the case. Okay, once again, we're going to look at some downside price gaps here on the chart, and those are bearish technical signals. Here we can see the market had been trending higher. In fact, scored a bearish double top reversal, started to trend lower and punched below that downtrend line, the green downtrend line, so that's a bearish clue within itself. But then you saw a price gap lower, which is another bearish clue, and the market went on to trade solidly lower. And if we look further at this chart, I don't have it highlighted here, but the last several trading bars, it looks like we might be forming a double bottom reversal pattern here on this market. Once again, I want to reiterate, these charts that I'm pointing out, I don't even have a name for these charts because these are various charts from different markets, but these types of chart patterns can be looked at and derived from any market. Some more price gaps. And here I want to point out an important congestion area. Once again, this congestion area or sideways trading pattern is indicative of a market where the bulls and the bears are struggling for price control on a near-term basis, with neither gaining much of an advantage. And then we see here at the very end, the market sees a bearish downside breakout from this congestion area. In fact, one of my favorite trading strategies is to find a market that has been in a choppy and sideways range that's well defined, as we see here. And then if the market makes an upside or a downside breakout, that would be an opportunity to, for example, in this chart, go short the market on a downside breakout. Another classic technical analysis pattern is a pennant pattern. The pennant pattern occurs when the market sees a strong upside price move. For example, this is called a bullish pennant. Market sees a strong upside price move, but then the bulls get a little bit tired. They need to rest, and they rest, and the market consolidates for a while, and then the market pushes back higher. That's a bullish pennant pattern. here we see a bearish pennant pattern. The market made a strong move higher and is starting to back off. It's backed off sharply from its highs, and then it sees some kind of corrective upside price action after that strong sell-off. And technical odds suggest this market here will see a downside breakout from this pennant pattern. Okay, we're going to look at a bull flag here, or a bullish flag pattern called a bull flag. We can see, once again, it's very similar to a pennant pattern, just a little bit different shape. We can see that the market has pushed solidly higher. It's saw kind of a downside correction where you can draw parallel trend lines on this downside correction, and then the market sees a bullish upside breakout on that last price bar that you see. And also on this chart, I've thrown on a moving average, and that's a secondary indicator, and I do use secondary indicators, even though what I call my primary indicators, like the basic chart patterns, the secondary indicators can be valuable trading tools also. And I'll get more into this on another webinar, but it's important to mention too that if you're using some secondary indicators or some computer-generated indicators that are working well for you, then by all means stick with it, because no trader, there is no one set trading methodology that works for all traders. All traders need to customize and improve upon and make their own methodologies that works best for them, and those will not all be the same. Now, this is kind of a tricky chart pattern. It's a falling wedge, but just by initial blush, you say, well, this market is trending lower and pushing into a wedge pattern. That should be a bearish pattern because it's a falling wedge. Actually, that's not the case. Anytime you see a falling wedge pattern like this, that's a bullish technical indicator that technical odds would suggest a bullish upside breakout. And once again, I want to point out, if you see chart patterns develop on the chart, technical odds on chart patterns would suggest a move in the direction that, for example, this falling wedge would suggest an upside breakout. However, it's not 100%. I mean, there could be cases where you see a falling wedge pattern like this develop and prices see a downside breakout. That's just the nature of the marketplace. Here's a symmetrical triangle or a wedge. It could also be called a wedge pattern that just kind of that is symmetrical. And symmetrical triangles are continuation patterns. So a continuation pattern means that the most recent trend in this market before it entered this wedge pattern was up. So when you see a symmetrical triangle like this form, the prices kind of get pushed into this wedge pattern, the technical odds would suggest an upside breakout. One more thing to point out on these wedge patterns or triangle patterns, the most powerful breakouts, either to the upside or to the downside from wedge patterns or triangles, occur at about the 2/3 to 3/4 point of the completion of the wedge or triangle pattern. And if the market you're following sees a perfect symmetrical triangle form where prices go right to the very point or the apex of that triangle, then that's a clue that that pattern is not very powerful and that more of the same choppy price action is going to occur. Here's a classic chart pattern that many of you have heard and that may be new to many of you, but the head and shoulders reversal pattern. Here we see a head and shoulders bottom reversal pattern, similar to the double bottom reversal pattern, but you see the market makes its initial low, rebounds a little bit, sees a corrective rebound, but then goes on to make a new low, which is the head or the H here. Then the market rallies a little bit, sells off again to come to create that second shoulder or the right-hand shoulder, and then rebounds again. That's a bullish head and shoulders reversal pattern. Once again, I threw another secondary indicator on this chart just to show how you can use these secondary indicators along with your primary indicators to get a better idea of what the market may do. This particular chart indicator, the secondary indicator, is the MACD indicator, the moving average convergence divergence. And those of you that follow my daily technical charts know that I do use that on those technical charts as a very popular secondary indicator. Here we see a head and shoulders top pattern. Once again, the market makes an initial for the move high by the left shoulder, backs off, but then makes a strong rebound, backs off again to form the head, makes a low, and then rebounds again right to the point where about the first shoulder was, and then backs off. And at that point, you can say this is a bearish head and shoulders top reversal pattern. These basic chart patterns were derived by traders back in the early 1900s, and they really haven't, the definition or the forming of those patterns really hasn't changed much over the years. The one thing I would say that has changed the past, say, 50 years is that technical analysis has become so popular that sometimes these chart formations will occur and so many people will notice them and they'll make their trades accordingly that they may not be as effective as the traders of the mid-1900s who just realized these powerful patterns and not very many people knew them, so they had the advantage of knowing something that not very many people knew. Whereas nowadays we do have heavy emphasis among many traders on technical analysis. That being said, technical analysis is still a very, very important trading tool. In fact, another way to put technical analysis and chart analysis is to say that when you look at a chart, you are looking at all of the fundamental and other news types event that have occurred in that market, and that's reflected right there in that chart. So all of the known fundamentals in the marketplace are reflected on that chart's price action, and that's a pretty powerful statement. Here we have a downtrending channel, and that's just a series of two parallel trend lines that can be drawn off of reaction highs and reaction lows in a trending price move. Here's a continuation of that downtrending channel, and that downtrending channel goes on to form a double bottom reversal pattern, and prices trend higher. Here we have what is considered a powerful tool in determining market tops and bottoms, and that is a key reversal pattern. Now, on this particular chart, you'll see that red line with the key reversal down points to the market making a top. And on that very same day that the market makes a top, it sells off sharply to close solidly lower on the day, and that price bar is bigger than the previous day's price bar. That means the high is higher and the low is lower than the previous day's trading range or the previous day's price bar with a lower close. If you see follow-through selling pressure the next trading bar or generally the next trading day if you're looking at a daily chart, then you're going to see a confirmation of a bearish key reversal pattern, and that is a clue that a market top is in place. Now, if an outside day down occurs without a market making a new high or a new low, that's still a significant development, but it's just not called a key reversal. It's just called an outside day down or an outside day up. An outside day up would be if the trading range is higher than the previous day with a higher close. Another picture of a bearish key reversal down, and there I threw some moving averages, some secondary technical indicators, some moving averages on the chart just to give you perspective on how secondary and primary technical tools can be used. Here's an important one that even many veteran market analysts and technical analysts are not familiar with, and that is exhaustion tails in a market. On this chart, we see a couple of examples of where a market has made a strong push lower on a daily basis and scored a new for-the-move low, but then in that same day or that same price bar, the market's rebounded strongly to finish that price bar near the high of the bar. What happens when that occurs is that the bears, have become exhausted at those lower price levels where that big bar is created, and then the market rebounds strongly as those bears become exhausted, and the market finishes near the high for the bar, and that's called a selling exhaustion tail. Conversely, here's a buying exhaustion tail where the bulls push prices sharply higher. They just become tired at those higher price levels, and the market backs off on that same price bar. Once again, this is a daily chart, so the price backs off on that same day, and prices close near the daily low and well off the highs to suggest that the bulls have become exhausted. So that's a bearish buying exhaustion tail. Once again, here we see a congestion area and a downside breakout. We saw the market gap lower, and then we just paused a little bit. Sometimes pauses, congestion areas are called pauses also in the market. And again, this is a downside breakout from a congestion area, and that's a bearish clue. Okay, this is an example of, this is a longer-term monthly chart. And see on this shaded area how for many months this is the oats market, but it can be applied to any market. The market has been trading in a sideways and choppy price pattern at lower levels for quite some time. And then 1 month the market makes a big price upside move to suggest further upside price action. Okay, Fibonacci retracement levels in markets are very important. And I can't get into the terminology with the time I have here of Fibonacci, but if you would study a little bit about Fibonacci, that markets have a tendency to make price moves of a certain percentage, such as 50% or 62% or 38%, and this is the use of Fibonacci generally requires a software program that can determine those Fibonacci retracement levels, but they are important support and resistance levels or important determinants of if a market makes a move like a 62% retracement of a price move and then rebounds, that's a chance that the market could continue to trend in the direction it had been. Once again, there's a 50% retracement of the blue lines I have here show the entire price move, and then the market backs off to a 50% retracement of that price move. That's a Fibonacci retracement, and then the market rebounds a little bit to suggest a near-term low might be in place, and that market could continue to trend higher. Once again, pauses are key in a market. If you see sideways, choppy price action, no matter what time frame you're looking at on a bar chart, and then the market makes a move beyond this pause or this trading range, that's a significant clue that prices could be making a bigger move, trending price move. Here's another little known technical trading tool that is powerful and important, and that I call it a collapse in volatility. Anytime you see a market a bar chart, no matter what time frame, that you see the smaller price bars that are, let's say, 3 or more price bars in a row that are smaller than the previous price bars, that means the volatility in the market has collapsed, and that suggests a bigger price move is coming. Once again, I'm going to repeat that. Anytime you see a price bar, 3 price bars in a row that have contracted significantly versus the previous price bars, they have to be 3 in a row. That's a collapse in volatility and strongly suggests a bigger price move is forthcoming. Now, I often get the question, well, what price direction is that bigger move going to be? Well, the collapse in volatility phenomenon does not determine the direction in which the bigger price move will be, but you could use other technical tools to try and determine what direction that bigger price move is coming. So the way a collapse in volatility would be a good trading tool would be if you've got good profits in a market and you all of a sudden see the collapse in volatility, you think a bigger price move's coming and you want to book profits because you're not sure which direction that bigger price move is going to be, you might want to take profits and get out of that market. Another example of a collapse in volatility, portending a bigger price move. And one more collapse in volatility, portending a bigger price move. And then once again, I have thrown on a head and shoulders, bullish head and shoulders bottom reversal pattern here on the chart. Here we have another longer term chart and another classic chart pattern, a rounding bottom reversal pattern. See here, we can see the market had been in a steep downtrend, starts to level off, and just looks like a kind of a rounding bottom price action there to signal a bullish clue that the downtrend is ending and that an uptrend is probably forthcoming. Another rounding bottom reversal pattern, and then the market has pushed higher and formed a bullish falling wedge pattern that I have pointed out here. We saw an upside breakout from that falling wedge pattern. And here we have the lumber market, and many commodity markets are more volatile than, say, many individual stocks. You're going to see what are called V reversal patterns, and this is more of a technical study or indicator that is just a good clue for future price action. If once a V pattern occurs, it doesn't have much predictive power because it's already occurred. But when you see these types of patterns occur in an individual market, it's a good clue that, you know, these types of volatile trending price moves can occur in the future in that same market. Okay, another rare pattern that occurs at market tops, it looks like a kind of a reverse wedge there. It's called a broadening pattern, or basically it's an increase in volatility at higher price levels. Anytime you see a market that sees bigger price bars or an increase in volatility at higher price levels, that's a bearish warning signal that a market top is close at hand or in place. And finally, I point out what I call chart aberrations, and you see that on this chart is a big price bar that occurred from a market shock that occurred. Sometimes the marketplace will just throw at you an unexpected fundamental event that just really roils the market, and big price moves will occur like this. They're just out of the blue and unexpected. So that's just kind of the nature of trading the markets. Is these market shocks can occur to produce these huge price bars that really are not any expected at all, and then the market settles right back down. One thing I want to point out is these slides that I've shown you and these chart patterns that I've shown you, don't expect that you're going to just attend this webinar for a half an hour and become an expert in identifying these patterns. I would suggest buying textbooks or doing further study. It takes a trained eye to spot these patterns, and it does take practice, just like anything. You don't become a successful lawyer or doctor overnight. It takes preparation and study, and becoming a good technical analyst and identifying these patterns takes study. But certainly the fact that you have attended this webinar today is a very good first start. It shows that you're interested. It shows that you're hungry for knowledge, and that is a very good start on the path to trading success. All right, we're going to get some questions here shortly, but I'm going to give it back to Sonia for a while.
Hi. So we've received already numerous questions, and we've selected 3 randomly. So if your question is unanswered, please know that we will try to respond to you by email, or we'll follow up with you and send you some information. One of the first questions that we have here is, they say that history repeats itself and that we are in the same scenario as in 1978 and 80. Do you agree with this statement?
I do agree with the statement that history repeats itself. In fact, if you look at longer-term charts and you look at price action in longer-term charts, you can certainly see that history repeats itself. So that's a very important thing to point out. Regarding the time frame of the late 70s, early 80s, I don't, recalling back at that time frame, I don't see the extreme collapse in interest rates that we have nowadays in the world. So I think that is a huge difference between now and then. But certainly, if you want to look at the price charts and you look back that far on a particular market, and you certainly can draw correlations with recent price history versus past price history, and that's why those longer-term charts are so important to examine, even if you're a shorter-term trader.
Okay, and the second question is, what are the signs to buy or sell physical silver, and are they the same signs as other types of trades?
That's a good question. As I pointed out in my webinar, there are these tools that I use, these technical trading tools can be applied to any market. And silver, gold, whatever, currencies, and the same principles apply to all kinds of different markets. So if I'm looking at a silver chart and I see prices in a trading range and they break out to the downside, that's going to be a bearish clue. Silver, just recently the silver has been in a near-term, mostly bearish situation where prices have been trending lower. If that price downtrend in silver gets broken on the upside, then certainly there's going to be some buying opportunities there. So, but keep an eye on those daily charts, those charts that I produce for Kitco on a daily basis. Notice those trend lines I draw. When silver pushes above a trend line on those charts, that's a bullish clue.
And how do you identify a sell signal? And do you recommend incremental selling in a rising market?
There's no right answer for that question. The one thing I would say is if you are going to do, it's called scale selling or scale buying. If you're going to get into a market in a position, and then once the market starts moving in your direction, you add to positions or you take off positions as you make profits, that's fine as long as it's in your initial plan. The mistake that can be made is for a trader to be in the middle of a trade and be excited and all bulled up, say, because he's making profits on the long side of a market, and then he wants to add positions so he can make more money. That's the greed factor setting in. Usually those types of plans don't work out because the trader's flying by the seat of his pants, doesn't have a prepared plan beforehand. So once again, having a plan of action before you make that trade, knowing not only when you're going to get into the trade, but how you're going to get out or when you're going to get out, very important. Once you have that plan, you generally want to stick with that plan during the heat of battle in trading.
Wow, thank you very much. On behalf of everyone, I'd like to thank you very much, Jim, for this great presentation that we had today. For all of you, if you're interested in buying gold or any other Kitco's products, we have put up our phone number and online information, and you can call us anytime at 1-877-775-4826. And Kitco will be hosting other free coffee break webinars in July, so please keep checking our website for more details. And thank you all again for attending the presentation.